They like to own paper on real estate. They like the real estate to be the collateral, but all they want to own is debt. So they're getting paid because there are two types of entities on the face of this earth that absolutely thrive on evading all forms of responsibility and accountability. And those are banks and governments. Both of those institutions will do absolutely anything to avoid all personal accountability.
So the big question is this: how do real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we conservatively grow our real estate business to support our families, finally leave the corporate rat race, and build a legacy? That is the question. In this podcast, we'll give you the answers. I'm Ed Matthews, and this is Real Estate Underground. Greetings and salutations, Real Estate Undergrounders. Thank you so much for joining us today. At the top of the show, I wanted to just make mention that if you get something out of this and you're enjoying all these shows that we've done for you, if you could rate and review and subscribe, it really helps us grow. Thank you so much for joining us today. So today I'm with, if you're watching us on YouTube, I feel like the old Brady Bunch, which I know I'm dating myself, where you've got the girls over on the right side and the boys on the left and mom and dad. And I guess that makes me Alice.
I'll be Marcia.
You are the best looking one of us, Matt. So, fair. So Prefore Profits, this is an interesting opportunity because these guys have come together, two separate companies, right, guys?
Yeah, that's right.
And professional problem solvers, which is something that is near and dear to my heart. And they are coming together to help real estate investors be able to recognize and work through creatively and otherwise how to solve people's problems to be able to take on additional real estate and move it through their portfolio, whether they're flippers or long-term holders or something else. So, gentlemen, welcome to the show. Thank you so much for your time today. And I think we'll probably go clockwise if you all want to introduce yourselves, and then we'll get into to William.
Oh, cool.
Yeah.
You just actually answered something for me, and I'm being public here, but I've never really been sure of whether or not everybody is looking at the same display.
Right.
So sometimes I think that for somebody else, maybe we're in different spots when you're looking at your screen, and I'm glad to hear that.
Cool.
Anyway, my name's William Bonnell. I've been a full-time real estate investor since March of the year 2000. That's when I first got involved. So it's been 24 years of doing this. Literally the only thing I've ever done for a living is real estate in my adult life. I had some jobs as a teenager, all of which I got fired from. And I had this tiny little insubordination issue and problem with authority. So being self-employed and being a business owner, being an entrepreneur was really the only option I ever had. And thank God I was good enough at it that I didn't starve to death. Basically, when I first got into this, I really was attracted to the idea of problem solving. I was really attracted to the idea of the chess game style approach to real estate where everything's strategic, everything's planned out. And I like to take on challenging stuff. I find it really engaging mentally. And I think it's wonderful to be able to help people out of certain situations. We all know here in the United States, we don't exactly have the best financial education growing up, nor do we have the best legal education growing up. And I found that with certain situations, such as being in pre-foreclosure or being behind on income taxes or things like that, people can end up in a situation where they're in what I like to refer to as a forced sale situation. So over the years, I've perfected a ton of different techniques for resolving these issues favorably for people and either getting them out of foreclosure, getting the IRS off their back, getting state income tax agencies off their back. And I've been doing real estate investing nationwide since 2011. I was only working in the New England area from 2000 to 2011. And in 2011, I opened up and started working outside of New England. And since then, I've successfully closed deals in 38 of the 50 states. So
Cool. All right. Matthew, how about you?
Yes, I actually got involved in real estate. Believe it or not, I had a short run as a New Jersey Transit train operator. And I got involved in the mortgage industry in early 2000. And I ran a for sale by owner service. And we were killing it. Towards the end of the for sale by owner service, the physical service, I started to see where people were calling me in and asking me for help, asking me to get there before their spouse got home, which I thought was a little weird. I was married, obviously, at the time, so I don't know what you guys think.
One of all of us, so
Yeah. I don't know what's going on. Yeah, of course. Yeah, people were in one of those particular loans, and their mortgages were skyrocketing from whatever they thought the mortgage payment was going to be for life.
Right.
Mortgages weren't explained correctly to these people. And my career started at the end of 2004, going into 2005. And I took one of those classes and just put it all out there, figure out how to buy a house for as little as $10 out of pocket. And I was fortunate enough to be at the right place at the right time. I had collection experience also too. I was trying to figure out how to jam a square peg into a round hole was something that really worked with me and resonated. So followed through with it, built built 3 different companies, kept going to where I feel comfortable where I am right now. 2015, I went nationwide with my concept to help people in other markets across the United States. I'm in New Jersey, dirty Jersey. And yeah, it was just fascinating. It still is fascinating to this day what had happened in the timeline. If you look at it from really 2005 all the way up to 2024, and the face of the pre-foreclosure market in 2024 has changed forever. It will never be the same due to what had happened during COVID.
Well, we're going to talk about that because I have
Yep.
questions about that. Rick Hamrick, welcome to the show. Why don't you tell us about your background?
As Ed said, I'm out of the Kansas City market. I started a little bit different than these gentlemen. I worked in the W-2 world for a long time as a technical sales engineer and then VP of sales in a software company. Bought my first rental property in 2016 and then just dabbled in it as a hobby and then got serious about real estate investing in 2020, right? When the big C word came out, it was like, okay, I need to do something for myself. And as I got into it very quickly, I realized with my technical sales engineering background, I'm more about solutions. I was very solution oriented and going where you're actually needing and solving problems in challenging situations. I met William in 2020 in another high level mastermind, and he actually walked me through my first pre foreclosure property. And that's when I said, that's what I want to do. Instead of doing all of these 10,000 cold calls and texts and all of that type of stuff and competing against 5, 10, 15 other people for a deal where you end up being the biggest loser if you win the deal, is to go into the pre-foreclosure niche and actually learn how to provide solutions where somebody is forced to sell the property. And so since then, William and I have formed an educational group together called IPA for REI, and then teamed up with Matt to do the Prefore Profits event, which is a national educational series to help others actually add another niche or a new line of business to their market as we're getting ready to. What's on our doorstep and what's coming over the next 4 to 6 years is really why we're putting our message out there as much as possible. So that's what I do full time now. I basically quit my W-2 job in 2021 and have focused on doing real estate, both transactionally and from an investor standpoint, continuing to add to the portfolio, the whole portfolio, whether it's a rental property or a note. That's what I'm doing.
So let's pull the crystal ball out and let's talk about what you see coming. Obviously, the residential market and the commercial market, although both under the real estate umbrella, their fortunes aren't necessarily tied there as tightly as people may think. Let's talk about residential and then we can talk.
So maybe I'll talk about the residential, William, and you could talk about the commercial.
Perfect.
Yeah. And my bread and butter has always been the residential. People not understanding that, do they have a right to modify their loan? Do they have a right to settle their mortgage? Can they do a short sale on their property? Are they allowed to do it? Do they have any type of foreclosure defense that they can rely on? For me, starting in 2005 to now, I've seen some wild stuff go on and off the scenes as far as properties that were conditionally put onto the mainstream real estate on local MLS, and/or properties that were trying to be, finagled behind the scenes, that if it's a short sale, the investors frown upon that and they want the property listed on the local MLSs because they want, one, the property to have a fair chance to be shown, and it's actually an investor guideline. They can actually push people to foreclosure if they feel that there's fraud involved. So there's a lot of things that people don't talk about that are behind the scenes. 2005, I saw the beginning of what was going on. 2007, 2008, we were in full-on crisis mode. And then At that time, I was teaching classes in northern New Jersey, and everybody pretty much know who I was and my name. And then, for about another year or so, I was teaching, and then I went dork for a couple of years because I felt like I really wanted to understand the behind the scenes works, meaning that there really wasn't anybody that I could look up to and say, hey, you know what? I want him to be my mentor. There's so many different wholesalers out there and flippers, and everybody had these books. There really wasn't anything like that. So for me, I was fortunate enough to get trained, believe it or not, by the asset managers themselves. They liked me. They liked the way that I acted. I didn't overreact like a lot of real estate agents or investors would be, or even attorneys and paralegals would flip out and say, why do we not have this? Why do we have that? I was like monotone across the board. They like my personality of, hey, listen, no skin off my back. But at the end of the day, I really want to take the property back. They like that. Now, going into and searching out and working with people really across the United States. When I started doing in 2015, I had some major tragedies happen to me. So for me, for anybody that's listening to this, I want them to understand you can always have a reset. So if anything has ever happened in your life and you felt like you didn't have time to reset, I'm 53 years old. If everything went away and I had to reset again, I could make everything happen within 2 to 3 years and be back where I needed to be. It's not a hard time. Everybody looks at real estate as something it's either really like tedious and it's hard to do, and they rent and they never buy, or they own a piece of property, a piece of real estate, and there's really never any like in between. So there's like that 1%er that really can excel in the type of market that we're in as far as helping people. Now, let's fast forward to, let's say 2019. I did a really big event in New Jersey, and I was talking about how I thought there was going to be a correction in the market. Nobody knew COVID was going to come, and definitely not at the magnitude that it came. COVID has really destroyed real estate because what it did to the banking industry in giving people deferments, giving them forbearances. And a lot of the people that I work with have already had modifications in the banks.
Right.
So it really didn't fit the mold. So some of these people were really trying to take advantage of the system itself, and they really screwed themselves because a lot of these homeowners already had a step rate program and ended them at an interest rate of about 3.5%. Now you go through the whole COVID protocol, and those people didn't understand the model of what that was about. It was the forbearance. Now their interest rates that were 3.5% were creeping up to almost 8%. Right there, that's another wave of foreclosure. So obviously there's a lot of other stuff in there, and I want to be fair to everybody else that's on here as well. But going forward, 2024, if you think short sales, you do not know short sales the way the three of us understand what's going on in the market.
Well, all right. But by the end of this 30 minutes, hopefully we'll at least take a few steps forward. So
100%.
Well,
Yeah. First and foremost, one of the things that I want to throw out there is every single time that I hear people talking about a wave of foreclosures, and I think there's a reasonable cause for this happening. The idea of losing the roof over your head, especially for a family. I mean, it's one thing for a 30-year-old single guy that can just go out and rebuild their own life and do whatever. Still, it's sad, of course, but it's an entirely different thing when there's like children involved or elderly people or anything like that, right? So I think people naturally assume foreclosure is something that happens almost exclusively to owner-occupied residential real estate. And the reality of the matter is that's simply not the case, especially right now. What I'm seeing in the marketplace right now, and I get a lot of crap out of people that are extremely defensive of the residential real estate market being so strong right now and saying there's not going to be a wave of foreclosures, there's not going to be this, there's not going to be that. To some extent, I do agree with what they're saying. I don't think we're going to see 2008 again in terms of owner-occupied residential real estate because of things like Dodd-Frank, the CFPB, and many of the other things that have been done, the SAFE Act from 2008. Many of those things that have been done have actually set it up in such a way where owner-occupied real estate, generally speaking, they've got many more options from a consumer protection standpoint. However, where I'm seeing a massive uptick in pre-foreclosure activity right now two separate things. Commercial real estate, number one. When I say commercial real estate, the two areas where I'm seeing them hit the worst, the two subsectors of commercial real estate that I'm seeing the worst damage in, although I will be candid and say I'm seeing absolute crap in most areas of commercial real estate right now. Commercial real estate is taking a beating. Office space is dead. It's just plain dead. Some of the biggest, best office buildings in some of the largest and most powerful cities in this country are hovering at or below 50% occupancy right now, let alone not cash flowing. They're not even covering their own expenses. Where that gets really scary is when you start thinking about some of these million-plus square foot properties that used to house hundreds of companies, half of which have gone out of business. If these properties are unable to keep up with their financial obligations, in particular their property taxes, that has an absolutely catastrophic effect on those local cities. Right now, we're seeing strategic defaults in the office space like I've never seen before.
Yeah.
We're seeing strategic defaults on hotels like I've never seen before. People just walking away because, and a lot of people don't think about this because they're not thinking about the causation of things. But when COVID hit, one of the industries that got absolutely clobbered initially was the hotel industry.
Sure.
The hospitality industry got absolutely killed.
Yeah, of course.
So what happened is their finances plunged in a lot of cases. Many of these hotels around the country, particularly ones that were built in the 70s, 80s, and 90s, are now at a point where they have balloon payments coming due. There's literally more than $6 trillion in balloon payments coming due inside of the next 24 months, some of which are next week, some of which are the week after that, some of which are 2 years from now. And the programs to refinance them are almost non-existent. And the bulk of these properties do not qualify to refinance on their own financials because, as we all know, income property is less dependent on a credit score than it is on the financial performance of the actual asset. When you've got a hotel that's been performing miserably for the past 4 years compared with what it did for the previous 25, trying to refinance that hotel is a pipe dream at best. It has to be liquidated at a much, much lower number, and it's going to have to go through a market cycle. The other thing where I'm seeing a lot of pre-foreclosure activity that a lot of people don't talk about, some of the things that are technically residential property, but a commercial purpose. So I'm seeing a lot of investors in two particular areas residentially where I'm seeing investors getting slaughtered. Short-term rentals is one, and that's largely because of HOAs, cities, and even counties placing restrictions on it. Also because of the hotel lobby that has obviously been railing against it as well for years now and spending millions and millions of dollars trying to wipe out Airbnb and VRBO and all those other companies. And then we also see this BRRRR strategy that was really, really, really popular in the residential real estate investing world for a very long time. And now with the interest rates being what they are, a lot of people got caught in the short-term expensive loans that they used to acquire the properties, the hard money loans, where they anticipated being able to refinance out. And they're finding that when they refinance out into a fully amortized loan at 8 or 9% interest for their rental property, it's really not better than the 12% interest only or 10% interest only that they were paying on the hard money. But the hard money loan is, of course, short term. So now they have to refinance out. Many of them simply aren't able to. So we're seeing investors in the residential space getting clobbered. You got to bear in mind, it wasn't just mortgages people stopped paying. People stopped paying for the roof over their head, period. Renters quadrupled the amount of mortgages that fell behind. There were literally 4 times as many renters that were behind on their rent by 90 days or more than there were mortgages that were that far behind. Because it's a lot easier to fall behind on your rent when there's a moratorium on evictions. It's a lot easier to fall behind on your rent than it is to fall behind on a mortgage because rent's typically not reported to your credit bureaus. And as long as your landlord isn't of the variety that does report to the credit bureau, as long as you don't actually get evicted, as long as you stop it before it gets to that point, there's much less tangible consequence, like system-wise. So that's the biggest difference that I'm seeing right now. I don't think that residential owner-occupied foreclosure activity is going to be anywhere near where it was in 2008. But I do firmly believe with every single cell in my body that over the course of the next 2 to 6 years, what's going to happen to commercial real estate, particularly office space, apartments, and hotels, it might make 2008 look like a trip to Disneyland.
Really? Okay.
Yeah.
We'll get into that in a second. Rick, I want you to tell me about the event that you have come up and how you can help real estate investors figure out how the heck to help with all these various asset classes, and what are some of the strategies that you guys utilize every day to run your own businesses.
Right. Yeah. Thank you for that. The coming together, the culmination of RRG and IPA coming together to put this event on is really to help others understand how to build a sustainable business in any real estate or economic environment. And that is truly understanding what are the 8 options that somebody has, whether it's a commercial property or a residential property. What are those options? Because the banks and the institutions aren't necessarily looking out for the borrower or the consumer themselves. They have a specific KPI and they're going to steer in one direction. But if you truly understand what those 8 options are, starting with, curing the arrears or curing the default, to selling the property outright with equity in it, to doing some type of a loan modification or a deferment, all the way through the acquisition techniques, right? And that's largely what we'll focus on is the acquisition techniques. Some of the best ways to do that are to take over a property subject to the existing mortgage, or do a lease option or other creative transaction, and or a short sale, right? When there is no equity or low equity, how do you help a borrower or an institution out of that? So we'll be covering everything from how to source and find these leads, what do the systems and process and marketing look like, all the way through my 8 options, all the way to the exit, because 2 of the last positions are bankruptcy and foreclosure. And the 3 of us say any day and every day, foreclosure should never be an option, right? And when you know what you're doing and who you're talking to, the banks and the institutions really look at you as an asset on their side. They see you as part of the loss mitigation team, and they would much rather come up with a pre-foreclosure solution than actually take the property back for a ton of reasons. So that's what the 2.5 days is really going to be about, is enabling people who generally shy away from this niche, rightfully, right? If it's no money or no equity, low equity, they tend to trash a lead and throw it away because they don't know what they're doing. And they don't want to be the cause of the person on the other side getting foreclosed on. So it's really not understanding what to do in those situations that we're educating everybody on, starting with that event. And then over the next couple of years, we plan to just continue to do this. So that's what it'll look like. We've got a VIP session on raising private capital and exit strategies there. We have VIP dinner. We have an open reception. It's just going to be about networking and being in the room and building that army of resources around the country, because we don't focus on everything. We focus on our niche and like when I say the 8 options, when it comes to a loan modification, William and I outsource to Matt. That is his income producing lane. We're focused on more of the investor side, right? The subject to lease option or investor short sale side of things. So it's being aware of what's there, finding what fits your bag of tools, and then adding that to your business going forward so that you can remain relevant in any economy.
Sure. And it's for any real estate investor out there, whether you are single family, commercial, like William was talking about, or multifamily for that matter, having these tools, having these clubs in your proverbial golf bag provide just one more way you can help a owner figure out how the heck to get out of the hole that they're in. Because William was talking about the change in mortgage rates. I'm seeing the exact same thing in multifamily world writ large, right? And it ranges from the 4 families down the street to the 250 plus unit buildings all over the Sun Belt and Midwest. And it was Moody's, I believe, had a report. It was a couple of years ago, but they reiterated it in this past January, where they said basically a quarter of the adjustable rate mortgages that were coming up for repricing or refinancing this year, and this is just multifamily commercial world, could not be repriced because of the exact reason that William mentioned, that they overpaid for a building at a 3% rate. And now that rate is 6.5%, 7%, 8.5%, depending on the property area and bank. And they simply don't pass the DSCR test. They don't cash flow sufficiently to be able to warrant a refi, which is causing a lot of pressure on a lot of different investing groups to sell off these assets, try really hard to preserve equity. But the fact is that other investors know what's going on as well. And we are not going to overpay and make the same mistake that we've seen out in the market. And so it's definitely, I don't know that it's 2008. I'm not sure I agree with you, Bill, but let's talk in 18 months and perhaps I'll bet you dinner on it at some point. And I'm happy to come to you because Clearwater is an absolutely gorgeous place. And Haddam, Connecticut is, yeah, it's nice, but it's more cows than humans. So you win vacation award. But the thing is that I think the banks are, because of all the various regulations that occurred in 08, 09, 2010, 11, the banks are far better capitalized. Where I see the pressure is in the commercial lenders and the ones that are backed by hedge funds and private equity. Those are the ones that the collar's getting a little tight, right? And the thing that you said really resonated with me, and that is, if you're out there listening and you have a project, whether it's a development project or a commercial residential, commercial office, industrial, single family home, whatever, there is always a solution, because here's the inside thing, and you mentioned it. The bank doesn't want this on their balance sheet. They don't, right? That's not the business they're in. And it becomes a dead asset on their balance sheet, which makes them and their company less valuable, which means everybody in that company that's entitled to bonuses don't get them because their balance sheet is jacked up. So they will move heaven and earth, especially if you do the responsible thing and pick up the phone and answer the calls or answer the emails and just talk to them, because will put you in the bucket of, hey, this is an asset protector. This is someone that's trying to figure this out, and we need to work with him because we don't want his portfolio on our balance sheet, because then we have to go in and rehab it and get it right and then sell it off. And none of that is the expertise of a private equity group or a hedge fund bank, right? None of it is. Any comment?
I absolutely agree with that. I think they're definitely interested in trying to work things out. And for that very same reason, in all honesty, commercial foreclosures, commercial pre-foreclosures are 1,000 times more profitable than residential ones are, for that exact reason. Because all of the reasons that any given financial institution does not want to take back real estate, they like to lend paper. They like to own paper on real estate. They like the real estate to be the collateral, but all they want to own is debt. So they're getting paid. Because there are two types of entities on the face of this earth that absolutely thrive on evading all forms of responsibility and accountability. And those are banks and governments. Both of those institutions will do absolutely anything to avoid all personal accountability and responsibility in any given situation. And the very same reason that banks hate foreclosing on a bunch of houses all over the country and having to mow those lawns to stay off the radar of code enforcement and having to shovel the driveways in 46 of the 50 states and all the rest of that stuff, they don't want to deal with that. But it is 100 times worse when you're dealing with a 1 million square foot office building that's completely and utterly vacant, and you have to pay the taxes on it. You have to keep it insured. Now, of course, it's vacant and it's not occupied by anybody. So you end up with the same forced placement insurance situation that people end up with in the residential world. The carrying costs alone, most financial institutions cannot afford to foreclose on those types of assets. The carrying costs they would have thereafter during the REO timeframe could wipe them out completely and totally. So I'm finding that the discounts that I get on commercial short sales make residential short sales look irrelevant, quite frankly. We're getting on a regular basis, I'm making offers at 60% of as is value and not even getting a counteroffer.
So let me ask, so first off, I'm intrigued. Secondly is, would you buy office when it's cratering?
Because I believe in doing different things with the very same space. For example, one thing that it's my personal thing. Okay. I kind of thought it was cool. I have a bunch of cats. I'm really into cats. I always wanted to get like a really old church building and turn that into a personal residence. Because I believe a lot of commercial properties and a lot of these really overbuilt properties, whether it's a religious building or a government building or a massive office building that was once built for, like Xerox. Xerox is a great example. The Xerox building in Washington, D.C. just sold for $25 million. Okay.
Seems low.
Yeah, the last time that it sold was in 2011 for $115 million.
Hmm.
So it just sold for less than 25% of what it sold for nearly 15 years ago. That's not a good indicator. But buildings like that are constructed with such high quality. They're hurricane proof, they're tornado proof. Some of them are literally earthquake proof with the level of engineering that they have. And we have a massive housing shortage in this country, which is the reason that residential property is staying so high. It's so stubborn. There's not enough housing. We have too many people. Granted, our population 20 years from now, 30 years from now is going to be declining rather than inclining because nobody's breeding anymore. But for the time being, we're in such a situation where we're shy something like 4 or 5 million housing units in this country.
Last I saw, you're right.
A huge portion of what I personally intend to do with vacant office space, vacant shopping malls, hotels. I mean, hotels can be converted to apartment buildings readily, and they've got those tiny little suite rooms, which are much more of like an efficiency type unit. And the construction with some of them, you look at the average Marriott, the average Hilton, the average Hyatt that you go and stay in, those buildings are built much, much better than the average apartment complex is. It's a much higher level of construction. And they can pretty easily be repurposed. I personally believe a lot of these office buildings that used to house a whole bunch of companies and dentists and doctors and lawyers and CPAs and real estate companies and all that other stuff, many of them are no longer doing the brick and mortar thing, but the existing property in which those office buildings exist, in many cases, could very easily be converted to residential property, and in some cases, a far superior quality of residential property. You could be turning that Xerox building into a brand new version to Trump Tower.
Yeah, it's an interesting play. I have friends, that's all they do now is they were multifamily investors, and now they've built a cohort of people that they go around the country. They look for very specific footprint and layout in terms of MEP. And when they find it, they jump on it and they convert them into one bedroom efficiencies, all of them. And it's a really interesting play. So Matt, I'm curious about what you're seeing in the residential space in terms of William mentioned burrs and short-term rentals. Obviously, that's a big part of the residential world. And in fact, it was, if you talk to Bigger Pockets, that was two of their favorite asset classes for, the better part of 10 years, right? And now people are starting to realize the risk that is around that. But the good news is there is a way out. And so I assume that's part of your world as well.
So people right now that are not qualifying for the modifications, I shouldn't say they're not qualifying for it. They are qualifying for it, but the terms aren't favorable for them. They're comfortable making, let's say their payment's $2,500 a month. And now all of a sudden the payment is now $3,900 a month. So it's not that they can't make it. It's now that it's strapped. And if God forbid one thing goes wrong, which I'll tell you guys, honestly, I had a water claim in my house. My insurance, my homeowner's insurance is at $2,300 a month. I got quoted almost $15,000. Right there, an insurance claim could put somebody into foreclosure.
Please tell me you mean $2,300 a year and not $2,300 a month. I just had to throw that out there real quick. That sounds like an abnormally. I don't know what kind of house you live in, bro, but it sounded like you got that church that I was just talking about.
$2,300 a year was my homeowners.
Yeah,
I got as high as 15,000, and we ended up settling at 5,300 a year, which is still bananas. And then they furthermore went to say that I live in a big area, that Jersey is considered a big area. I was like, oh, hey. So I said, now the insurance companies are redlining states. They're very fearful of water. So I don't live in a flood zone. I don't live in a floodplain. There's no water around me. It just we had freakish incident in our house, happened to be the same pipe, 18 months apart. I'm being told, stay in the insurance for 10 months in the full year, your insurance rates will go back to normal. So they have these action forgiveness nonsense things. I don't really believe in it. But as far as people that were in modifications and then tried to sell their houses thinking that they have equity in their house, and they did a forbearance. So let's just say you did 10, 15 years ago, you did a modification, and now you have a silent second. Or maybe you've got a partial claim on your property you don't even know about, which I actually have 3 transactions in my 2 now, 1 closed, in my pipeline for that very reason, thinking that they've got all this equity, and then they realize they don't. And then going back to the homeowners and saying, "Hey, sorry, Mr. and Mrs. Homeowner, you thought you had all this equity, but the reality is you have no equity in your house. So it really shouldn't matter what your house sells for." I may or may not get shot by the mortgage industry, but I will say this. I'm telling people, don't overpay, because if you're going to overpay, you're going to keep increasing the value of these areas unnecessarily, and nobody's going to win. Because a lot of these banks have insurance policies, and nobody talks about that. And these are some of the things that I talk about and that I teach. And it's important, I think, for people to understand across the United States. Yeah, people are going to overpay for property. My wife's doing a transaction right now. They're 2 months away from sheriff's sale. The woman's husband passed away 3 years ago. Guess what? 3 years later, she had a sale date on her house. They had actually practically no mortgage left on their house. Now they owe 130,000. My wife was, because of the area and the neighborhood, she was able to get $65,000 more for that house over asking price, but she never would have gotten that lead if it wasn't for me. So I tell real estate agents, stop hiding from distressed real estate. There's a ton of gold in there. You can help people, right? And you can make money. If you put people for profit, you'll find a better way. And real estate agents, unfortunately, because I could say, as my wife's a real estate agent, I am friends with a lot of them. They're very cheap. They're on to the next deal. They're worrying about the next deal. They're not worried about amassing either properties, or trying to figure out how to promote themselves or put things back in place where they can market to these types of situations. So I will never be out of business as far as I'm concerned.
It's just human nature. The fact is, their realtors they're salespeople. And I don't mean grade that being one. Rick, I spent a bunch of years in tech sales and marketing as well. And I'm just as coin operated as any realtor out there. But the fact is that their job is not to understand necessarily the ins and outs of a short sale. Their job is to get the best possible price as fast as possible under the best terms, get it done, and move on. And it's a valuable service,
Right.
just not necessarily congruent with somebody's situation when they're in a bind. So guys, we're coming up on 36, 37 minutes into this conversation. I could talk for days about this stuff. But Dad, I'm going to go to your conference and I'll do that. One more time, why don't we talk about the conference, who should go, who's this for, and how do they get more information on the event or setup?
Yeah, very good. Yeah, you could visit preforeprofits.com, just PREFORE profits.com. And that's down in Clearwater, Florida here on the 28th of February. It'll be 28th, 29th, and then the 1st of March. Who should come? We're really having any real estate industry professional. We ultimately think it'll be an agent investor hybrid, but we've got attorneys and title companies and others like CPAs that are coming to the event. A nice list of sponsors and other interested parties that want to know how, as a lot of the industry is staying flat or even potentially declining in the asset sales, residential asset sales, William and Matt and myself are getting busier, right? So coming down to Clearwater, Florida is not only going to provide a lot of detail, a lot of education on some of the mysteries around the for sale pre-foreclosure world, but it's also going to put you in the room with a bunch of really awesome professionals around the country, essentially amassing and building an army of folks, because even in the residential space alone, there are more than 3 million homeowners that are more than 30 days behind. The three of us cannot help 3 million people. So we are trying to scream from the rooftop as much as we can to educate as many solution providers as we can, because foreclosure should never be an option.
Right on. Gentlemen, William, Bonnell, Matt, Merenoff, Rick Hamrick, thank you so much for your time today. I am on your website now, and I'm going to book a ticket. I'm actually going to be in Arizona the week prior, so I'm formulating a strategy on how I can convince my wife that it's a good thing that I'm going for 2 weeks. but we'll work on that. But she may be fully supportive for now. But
That's right.
the gentleman, thanks. And you're doing a lot of good out there for a lot of people and hope for it. And I wish you continued success, because every house that you acquire in your business solves a family's problem. That's a big deal. And I appreciate it. I appreciate you. So congratulations. And we will put all of the additional information on the show notes as well as on the website. And we'll blast this far and wide as well, and see if we can help you raise some additional interest in the event. So thank you for putting this on, and
Appreciate it.
continue good fortune.
I greatly
Thanks, Ed.
appreciated it. Thank you.
Thanks.
This has been the Real Estate Underground podcast. Thank you so much for listening. Don't forget to rate, review, and subscribe. It helps us grow. Until next time, happy investing.